Thanks, Fiona, for the introduction, and hello, everyone. Thank you for joining us today. I'm Becky, a tax partner at PKF Melbourne, and I'm excited to kick off our webinar on key emerging transfer pricing issues and the interplays with Pillar 2 in the Asia-Pacific region. The objective of our webinar today is for us to provide you with insight and practical tips for navigating the complexities of transfer pricing issues in the region. And in terms of the agenda, we will start with the transfer pricing landscape in Australia, followed by Malaysia's, Singapore, and we will wrap up by discussions on common issues and trends across the regions as a whole. And as Fiona mentioned, we will have a Q&A session at the end of the webinar, and we'll do our best to address the questions within the time frame. If not, we will respond to you via email. So let's start with Australia. The transfer pricing landscape in Australia is highly complex, and it can be broken down into three areas that we wanted to highlight to you. The first one is the transfer pricing rules. The second one is the key compliance obligations that taxpayers are expected to address and communicate with the ATO. And third one would be the recent development that taxpayers should be aware of, so that they can have a defensible transfer pricing positions in line with the change of the new rules. So in terms of the transfer pricing rules, they are primarily governed in the subdivision 815B, which outlines the arm's length principle, and subdivision 284E, which outline the compliance requirements. Under the arm's length principles, the actual conditions of the transactions between related parties must be reflective of the conditions as if they were conducted between independent parties under similar circumstances. And when pricing doesn't meet the arm's length principle, the ATO has authorities to impose transfer pricing adjustment and penalties for non-compliance. So therefore, taxpayers are required to prepare the documentation, and that documentation must address 5 key questions as outlined in the slide. And the couple points that we wanted to note is about the benchmarking analysis. Benchmark analysis here must be performed from Australian transfer pricing perspective, because in some certain circumstances, non-Australian transfer pricing or benchmarking analysis may not be accepted. And another point to note is the reconstructions provision analysis. In certain cases, the ATO has authority to reconstruct the entire transactions and substitute them with a hypothetical transfer pricing arm's length arrangement. So therefore, the documentations here must address all five conditions and questions outlined in the transfer pricing rules. And the documentations is expected to be prepared prior to the tax return lodgement due date. These rules and documentation requirements target to any entities that have international related party dealings. And for entities that are significant global entities, SGEs, which have global annual income over $1 billion, they are expected to prepare and lodge additional reporting obligations. Those are local file, master file, and country-by-country report or report notifications. Those obligations are required to be lodged within 12 months of the year end. And As an SGE, the penalties for non-compliance are significant. It can be up to $825,000 per tax document lodged late. So therefore, compliance is essential, documentations is essential. So taxpayers are encouraged to ensure that they prepared a defensible transfer pricing documentation and meet all of the reporting obligations for country by country reporting. In terms of development, there are 4 key developments that we wanted to highlight in the slides, and 2 of those will go into further details in the next slides. The first one is thin capitalization rules. It set out the limitations on the interest deductions for financing arrangement using earnings-based measures. The second one is the Intangibles Migration Arrangement, PCG. This outlined the ATO's approach and the risk assessment framework in connections with intangibles arrangement. We'll go into further details in the next slides. And one more point to note on this slide is about simplified transfer pricing record keeping options for certain SMEs business. If they meet the criteria outlined in the simplified option, they can prepare a simpler transfer pricing analysis. So therefore, taxpayers are encouraged to check to see whether they are eligible to any of the 7 options available for the simplified record keeping. Now we'll move on to the first emerging issues, which involve cross-border financing arrangements. Cross-border financing arrangements cover both inbound and outbound financing transactions. For example, Australian subsidiary borrows funds from an overseas related parties, or extend funds to an overseas related parties. So this slide, we outline the key steps that taxpayers are expected to undertake to ensure that the cross-border financing arrangement are defensible from a transfer pricing perspective. Those key steps are, first one, need to ensure that transfer pricing rules have been addressed. 2, debt deduction creation rules need to be addressed. And 3, thin capitalization rules. So we'll walk you through each of the steps. The first one, transfer pricing rules. Previously, the attentions of the ATO when it comes to cross-border financing arrangements is largely on whether the price of the financing arrangements are appropriate. So meaning whether the interest rate is too high or too low. But with the new rules, on top of the interest rate, taxpayers are required to prepare a separate transfer pricing analysis to look into the quantum of the debt, because it needs to answer the questions of how much debt is allowed for Australian tax purposes. They change the landscape fundamentally. So from now on, both interest rate and quantum of the debt need to meet the arm's length principle. And moving on to the second rules, debt deduction creation rules. With the introductions of the debt deduction creation rules, it operates to deny debt deductions on intra-group debt that lack of genuine commerciality. And it can happen in 2 scenarios. 1, borrowing from an associate to fund an acquisition of a CGT assets from another associate. For example, an entity borrows fund from a parent company to fund the purchase of these trading stocks from a sister company. This type of debt arrangement will be denied under the debt deduction creation rules. The second scenario is borrowing from an associate to fund the payments for royalties or loan repayments or distribution of dividend to an associate entities. This type of debt arrangement will also be denied under the debt deduction creation rules. Coming to the third point, only after the transfer pricing rules have been addressed and debt deduction creation rules has been addressed, then thin capitalization rules can operate. Under these rules, taxpayers can choose one of the three tests to calculate the maximum amount of debt deduction that they can claim in the fiscal year. The first test is a fixed ratio test. It is a default test. This test allows entities to claim net debt deductions up to 30% of the tax EBITDA. The second test that taxpayer can choose is a group ratio test. It is an elective test. This allows entities to claim net deduction to the ratios of the group's net interest expense to EBITDA. And this test will be relevant for highly leveraged groups. The third test is the third-party debt test. As from the name of the test, this test will allow the debt deductions for third-party debts, but not from the third-party debts. So therefore, this test will be suitable for taxpayers which are third-party debt only. So, in summary, when it comes to cross-border financing arrangements, taxpayers are now required to apply debt deduction creation rules, before thin cap rules, and transfer pricing rules, also before thin cap rules. And when it comes to transfer pricing rules, it's relevant for both the amount of debt and the interest rate. So taxpayers are required to ensure that they will go through all the key steps when it comes to financing arrangements. The next emerging issues that we wanted to share with you is about intangibles. So intangibles, in this slide, we will outline the overview of the intangible assets. The most common transfer pricing methodology can be used to evaluate intangible assets. And importantly, we will highlight to you some most common mistakes or common misunderstanding about transfer pricing positions for intangibles. So intangible assets can include intellectual property, patents, trademarks, copyright, or know-hows or business process. And related party dealings for intangibles may include transfer of intangibles, license of intangibles, or involvement in DMP activities, which refer to development, enhancement, maintenance, protection, and exploitation. And when it comes to common transfer pricing methodology can be used to evaluate the intangible transactions. They may include the CAP, comparable uncontrolled price method, or profit split method, or cost sharing arrangement. In terms of common mistake, we want to highlight at least one here, which is mischaracterizations of DMP activities. For example, we have a holding company that characterized as a legal owner of an intellectual property, but in reality, it doesn't involve in any of the activities of development, enhancement, or protection of that intangible assets. In such case, because of the mischaracterizations of DMP, the income generated from the intangible may be misallocated. And in that case, the ATO may reallocate the profit back to Australia, where the actual economic activities are taking place. We also wanted to highlight